And then also they're still eligible to show the income to basically be put inside that house. That's exactly, we do this nonstop. And it's really simple. It's really simple. Any questions about that? Any comments?
No, I think that was a great example.
Okay. And then that's truly what I wanted to show. I quickly want to go over the next thing real quick. It's just different forms that you may see with your clients. It can be a K-1. If you see what we call a K-1, just know that they have some type of business tax return that they filed, and there's some type of owner of it. So this is considered income or loss for them, depending on if that business was profitable or not. So if you see anything regarding a K-1 when it comes to taxes, that means they had a business that they're either 100% owner of, or they have some type of ownership percentage on. The next one is 1120S. That's another business tax return. It's not going to be linked to your personal. The K-1 is, but this is an own separate tax return that you file separate from your business. The K-1 basically gets attached to your personal. Same with 1065. That means they're in a, yeah, go ahead.
So basically the K-1, I mean, because I've been doing the K-1 for several years, but I don't understand it because it's not my field of expertise. But so I have a personal tax return and then a K-1 that's always filed. Are they separate, or is that an attachment to?
That's an attachment to.
Okay.
So I'm making the assumption you have some type of S Corp.
Yeah, so I have an S Corp, and my S Corp is paid with all my real estate transactions. And so my business name is Living Will Realty Group. And so Living Will Realty Group pays to me Shoels.
Gotcha. Okay. I got you. So,
yeah.
So guys, for the teaching purposes, she has what we call 1120S. She files her business information, that profit and loss, all those business numbers gets filed on this tax return. Now, on this tax return, it shows that she has 100% ownership. And when it comes time to her filing her personal taxes, she needs to attach what this K-1 is. Her business probably made, I'm just throwing out random numbers, I don't know, probably made $20,000 right in profit. That means $20,000 in basically ordinary business income will be on this K-1, and that income will show up on her personal tax return as taxable income. She will be taxed on the personal level, never that business level for the 1120S. So that's what's going on there. So if you see a K-1, that just means they have some type of business. It's either a partnership or a S Corp. And then once again, these are just different type of forms that I want you to be comfortable with. That means they have some type of business tax return out there, guys. And then know that there's what we call 1120C. It's different from the S Corp, but this is one of the only taxes where it's not linked to your personal. Your entity will be paying taxes at. It's called the 1120C, or just the corporation tax return. So this is basically it's its own separate entity. It doesn't flow back to the personal business owner. And that's all I got for you guys. I know I had 30 minutes, so I just wanted to kind of share some things to look at and what to give your CPA or what to just look for when you're dealing with a client.
Yes. Well, thank you. That was another question, though. So I do have several clients that have businesses. They may take a break with their businesses, right? And let's say for an entire year, they didn't make any business transactions, which means they have zero expenses, zero profits, right? And so do you recommend, or not recommend, but do they supposed to file taxes even though the business didn't have any activity?
Yep, they're supposed to file taxes. I like to file what we call a zero activity tax return to meet compliance. And then it shows the IRS that, hey, we had no activity here. So the whole thing with, we're reporting taxes, you need to show the IRS your activity for that year. If it's zero, it's zero. We just need to report it.
Got it. Okay.
Yep.
So that's new for me. So I'll definitely start telling my people, file those zero tax returns.
Zero activity tax returns. Yes, ma'am.
And do they incur penalty if they don't file the zero activity?
They will with the S Corps. In the partnerships, because you'll get what we call late filing penalty if you're not filing at all and then you decide to file for 3 years. So you'll get these late fees. So yeah, just need to report. And there's a spot on there too with certain tax software that just say, is this a zero activity tax return? And it's a quick button that you press. Me personally, our firm, we don't charge for those. If it's a client that's under our umbrella, and now it's different if it's a client coming from a different source.
Gotcha.
So, yeah. Any questions or comments, things that your guys are experiencing that I can answer? I know it's Monday, and I know, it's daylight savings time. I get it.
It is. No, I think one question that we had in the chat was, were you able to share those slide decks or at least the checklists with us?
Yeah, sure thing. I'll send that over. Let me put it in the chat real quick, and then.
And yes, I know your information is on the screen. If you could just pop it in that. Well, don't worry about it. Rachel, can you gather his information so when we send out the wrap-up email, we'll have Christian's information on there?
Okay. And I'll send the checklist as well to you.
Okay, perfect. One more question for you. With us being real estate agents, we like building partnerships with people. And so we would like to know, how can we build a partnership with you? How can we be a benefit to you as well as you and your firm be a benefit to us? Yeah,
so one thing that we do for a lot of our agencies, our mortgage companies, they need basically a good CPA to either write CPA letters or to file these quick tax returns. So one thing that we do, we know when buying a home is really time sensitive. So some things that we do internally, we'll basically move you in front of the line to file yours quicker. So it's kind of like we're holding you guys, we're putting more priority so we can basically get you inside that house. And then, of course, we're doing our CPA letters. So, we're helping you on the front end so you can close your deal quicker. And then also we get a client too. So that's how our partnerships has been going.
Love it. Love it. All right. Sounds good. Anything you guys want to ask Mr. Christian before we let him go?
Yes, just one question while you're here. So with you being familiar with the real estate industry, what would be your suggestion, not advice, because I know that we are not engaged in that, but your suggestion of the best business structure for, self-employed real estate agents?
Yeah, and it all depends, right, on what level you're at when it comes to profit. Like how Ms. Wells moved over to the S Corp. That tells me that her profit, if she has a good CPA, her profit was high enough where it's like, hey, you need to switch over to be what we call an S Corp tax election, where you're actually saving money in taxes. So I'm not sure, is everyone from Houston here? Is there? Yeah, everyone from Houston. So essentially, this is how I like to say it. Your S Corp is basically what we call HEB. It's shopping at HEB. And now you being what we call a Schedule C, if we're looking back at this screen, you being this Schedule C, this one over here, it's equivalent to shopping at Whole Foods, where you look, you're looking to the right and left, and then you look at eggs, and eggs is marked up by 15.3%. That's you shopping at under this Schedule C, aka Whole Foods, because you're paying that additional self-employer tax. So when your profit's high enough, I want to move you over to a cheaper grocery store where eggs and milk isn't jacked up by 15.3%. Yes, you're going to have to pay some payroll tax, get some payroll software to pay yourself reasonable comp, but it's still going to be cheaper than paying, 50.3 for eggs, and for an increase in eggs. So I want to get you shopping at what we call a cheaper grocery store. This is the S Corp. This is where I don't have to look at eggs and it's marked up by 50.3. It's a little bit cheaper here. But all that matters based on the profit of your business. And that rule of thumb in the industry is around 50, 60, 70. If you have that much in profit, that's when you probably should be looking to shop at a different grocery store.
Okay.
Yep.
Makes sense.
Yep. Yes, ma'am.
Great analogy.
Thank you so much. But yeah, any other questions or any comments? And I'll make sure I put that slide, with Rachel, so she can send it off to everybody.
No, I am good. I have jumped in and asked all my questions.
Okay. Awesome. But yeah, happy tax filing season, guys. Let me know if you need any help.
We will do. Thank you. Take care.
All right, guys.